Good morning. Welcome, everyone. This is an open meeting of the Public Company Accounting Oversight Board on December 4th, 2013. We want to welcome all of you who have joined us today in person or by listening to the webcast of this meeting. Today, the Board will take up a recommendation to issue a proposing release on improving the transparency of audits. The Board will also consider a recommendation to adopt proposed amendments to PCAOB rules and forms that would conform them to the Dodd-Frank Wall Street Reform and Consumer Protection Act. Before we proceed with the agenda, I will note for the record that all board members are present. The first order of business before the board today is a staff recommendation concerning a proposal to amend PCAOB auditing standards in order to improve the transparency of audits. To present the staff's recommendations on this agenda item, I will turn to our Chief Auditor's Office for the staff's presentation. Mr. Baumann.
Good morning, Mr. Chairman and members of the board. I'll turn directly to Deputy Chief Auditor Jennifer Rand, who will lead the presentation.
Thank you, Marty. Good morning, Mr. Chairman and members of the board. We are here this morning to recommend reproposing for public comment a series of amendments to PCAOB standards aimed at improving the transparency of audits. The reproposal would require the accounting firm issuing the auditor's report to disclose in the auditor's report, 1, the name of the engagement partner on the most recent period's audit, and 2, the names, locations, and extent of participation of other public accounting firms that took part in the audit, in the locations and extent of participation of other persons not employed by the auditor who perform procedures on the audit. These are disclosure requirements, and except for the disclosure obligations they would impose, would not change the performance obligations of the auditor in conducting the audit. Robust disclosure is the cornerstone of the U.S. federal securities regulatory regime and is essential to efficient capital formation and allocation. Today, however, the auditor's report typically contains no information about who served in the role of the engagement partner, or whether the firm issuing the audit report actually performed all the work. Many audits, both large and small, are a combined effort of multiple independent public accounting firms and other participants, not just the accounting firm whose name appears on the audit report. Requiring disclosure about certain aspects of the audit of a public company, including the identity of the engagement partner and other firms associated with the audit, would add to the mix of information that investors and other financial statement users have about public companies. Over time, this information could be valuable to investors in making investment decisions, as well as if they are asked to vote to ratify the company's choice of registered firm as its auditor. The reproposed amendments before you today have been informed after much public outreach and consideration. Jessica Watts, Associate Chief Auditor, and Lisa Calandrello, Assistant Chief Auditor, will provide further details about the reproposal. Before I turn it over to Jessica and Lisa, I'd like to thank both of them for their extraordinary effort in the development of this proposal, as well as to Dima Andrienko, Associate Chief Auditor, and to Katerina Disna, Assistant Chief Auditor. I also express great appreciation to our economists, John Powers, Andres Vanelli, and Morris Mittler, and to Jake Lesser and Mary Peters in the Office of General Counsel for their outstanding support to this project. And finally, I would like to thank the staff of the Securities and Exchange Commission who provided timely and helpful assistance and advice. I will now turn it over to Jessica and Lisa to present our recommendation.
Thank you, Jennifer. We are reproposing the amendments on disclosure of the engagement partner and other participants in the audit to seek additional comment on matters such as the usefulness of the information that would be required to be disclosed, the potential cost the reproposed amendments might impose, whether the reproposed amendments would have any effect on competition, and other aspects of the reproposal. Our recommendation is based on extensive public outreach and consideration. In 2005, we began to seek advice on and explore a variety of alternatives to make the auditor's report more informative, including by requiring disclosure of the name of the engagement partner. In 2009, we issued a concept release seeking commenters' views on whether it would be advisable for the board to require the engagement partner to sign his or her own name to the auditor's report. In 2011, we proposed amendments to the board's auditing standards that would have required disclosure of the name of the engagement partner in the auditor's report, and the names, location, and extent of participation in the audit of other participants. We received 43 comment letters on the 2011 proposal. This topic has also been discussed with the board's Standing Advisory Group and Investor Advisory Group on several occasions. Additionally, while we have been considering updating the auditor's report to provide more transparency, a body of academic literature has also begun to emerge related to disclosing the name of the engagement partner and information about certain other participants in the audit. The release discusses the relevant academic literature as part of our economic considerations. In developing our recommendation, we have considered a number of alternative approaches involved in the issue of transparency. A central consideration in developing our approach was to provide the information in a form that would be most easily accessible to investors and other financial statement users. We believe this is best achieved by providing the information in a document that is widely disseminated and commonly read by investors, such as the auditor's report that is included in the annual report filed with the SEC. While several alternatives were considered, I want to highlight our consideration of disclosure in firms' annual reports filed with the PCAOB on Form 2. The 2011 proposal included a recommendation to disclose the partner's name in Form 2 in addition to disclosing the name of the engagement partner in the auditor's report. This alternative is not being reproposed today, but we are again seeking comment on whether the disclosure should both be in Form 2 and in the auditor's report. As previously mentioned, we believe disclosure in the auditor's report continues to be the most appropriate alternative. We are proposing to make the amendments applicable to both audits of brokers and dealers and emerging growth companies. However, we are interested in commenters' views on whether the requirement should be applicable to such companies. Now let me comment on the disclosure of the engagement partner in the auditor's report. As Jennifer mentioned, the reproposed requirements would require the audit firm to disclose in the auditor's report the name of the engagement partner for the most recent period's audit. The reproposal, like the original proposal, would not require the engagement partner to sign his or her name to the audit report. Throughout our consideration of this issue, investors have argued in favor of more transparency and have indicated that such disclosure would be useful. We recognize that initially, at least, disclosure of the engagement partner's name without more information might be of limited usefulness because there may be little publicly available information about such individuals. Some commenters have suggested that over time, with the reproposed disclosure requirements in place, a body of information about the engagement partner's history will be developed that, when connected with other data, would be useful to investors and other financial statement users. For example, the disclosure of the name of the engagement partner, combined with other information compiled over time, could enable them to research the number, size, and nature of companies and industries in which the partner served as the engagement partner. We are reproposing this requirement because we believe that disclosure of the identity of the engagement partner will provide investors with information about the audits conducted for their benefit that they would find useful. Next, Lisa will talk about the proposed changes related to disclosing accounting firms and other persons.
Thank you, Jessica. The reproposed amendments, like the originally proposed amendments, would require the auditor to disclose information about other independent public accounting firms and other persons not employed by the auditor that took part in the audit. The required disclosure in the auditor's report would also state that the auditor is responsible for the audits and audit procedures performed by the other participants in the audit. In response to comments received on the original proposal, certain revisions were made to the proposed amendments. I'll discuss the more significant changes, specifically disclosure of persons, the threshold for disclosure, and the use of ranges. The reproposal, like the original proposal, would require the names, locations, and extent of participation of other independent public accounting firms that took part in the audit to be disclosed in the auditor's report. However, the names of other persons would not be required to be disclosed in the auditor's report. For these other persons, the locations and extent of participation would be disclosed, indicating in the auditor's report that persons not employed by the firm participated in the audit. The terms public accounting firm and persons are used as defined in the PCAOB's rules. In the reproposed amendments, the term person includes natural persons and companies or entities that are not also public accounting firms. Some commenters expressed concern over disclosing the names of persons that are not also public accounting firms in the auditor's report. After considering these concerns, the reproposal does not require disclosure of the names of persons that are not also public accounting firms that took part in the audit. Further, the originally proposed amendments included a 3% threshold based on the extent of participation in the audit for disclosing the required information about the other accounting firms and other persons that took part in the audit. Commenters expressed concerns that a 3% threshold was too low, and it would result in disclosing information that is not meaningful to users of the auditor's report. Others thought a higher threshold, such as 10%, would be appropriate and useful. We conducted an analysis to determine the impact of raising the threshold on the number of other participants that would be disclosed in the auditor's report. Based on our analysis, using a 10% threshold could significantly reduce visibility into participants performing a large part of an audit, compared with using a 3% threshold or a 5% threshold. After considering comments and the results of our analysis, the reproposal increases the threshold to 5% of total audit hours. Firms or persons from the same country would be disclosed separately if the percentage of total audit hours attributable to the audit or audit procedures performed by the other firm, or aggregate participation of persons from the same country, is 5% or more. In situations in which the extent of participation is less than 5%, individually for firms or in aggregate for persons from the same country, the auditor would not be required to disclose the names and locations of other accounting firms or the locations of other persons not employed by the auditor. However, the auditor would be required to group and disclose the aggregate percent of participation of those other accounting firms or other persons not employed by the auditor. The original proposal also included requirements for the extent of participation of other participants to be stated as a single number. Some commenters cautioned about potential difficulties for auditors in determining exact percentages attributable to other participants. Many of these commenters suggested that the board consider allowing disclosure of the extent of participation within ranges, which could still provide useful information to investors, but obtaining and presenting that information would be less costly and disruptive to the audit. After considering the views of commenters, the amendments were modified to provide auditors with the option for disclosure of the extent of participation to be stated as a single number or within a series of ranges. This would still provide greater visibility into the relative extent of participation of other participants while addressing the commenters' concerns over requiring a single number. The release includes examples of the application of these proposed amendments. The release is seeking additional comment on all aspects of the reproposal related to both engagement partner and other participants' disclosures. Specifically, the release is seeking comment on matters such as the usefulness of the information that would be required to be disclosed, the potential costs the reproposed amendments might impose, whether the reproposed amendments would have any effect on competition, and other aspects of the reproposal. As noted, there have been technical changes to the originally proposed amendments when the auditor discloses information about other participants in the audit, and we are seeking commenters' views on those revisions. Finally, we're seeking commenters' views regarding whether the reproposed amendments should apply to audits of emerging growth companies, as that term is defined in the Jobs Act. In particular, we request comments including any empirical data on whether application of the reproposed amendments to audits of EGCs would protect investors and whether it would promote efficiency, competition, and capital formation. In closing, the staff is recommending that the board repropose for public comment the amendments on disclosing the engagement partner's name and certain information about other participants in the auditor's report for a comment period ending on February 3rd, 2014. This concludes our presentation. We look forward to responding to any questions you may have. Thank you.
Well, thank you, Mr. Baumann, Jennifer Rand, Jessica Watts, Lisa Calandriello. I also want to thank others in the Chief Auditor's Office who worked on the project. As has been mentioned, John Powers, the Economic Advisor to the Chief Auditor, Dima Andrienko, And Ekaterina Dijna, I want to join Jennifer in thanking you. And also our chief economist, Andres Vanelli, who is at the table today, Morris Mittler, senior economic analyst in the Office of Research and Analysis, Jacob Lesser, and Mary Peters in our general counsel's office. All of these people have, as Jennifer Rand indicated, put in extraordinary commitments of time and effort, well above what one would expect to get us where we are today. The proposal before the board today would require audit firms to disclose the name of the engagement partner as well as the names of other firms and other persons that participated in the audit. The disclosure would require no new work by the auditor, yet as with previous accountability forms such as Sarbanes-Oxley's requirement that CEOs and CFOs personally certify their company's financial statements and internal controls, this proposal holds the promise of improving audit quality by sharpening the mind and reminding auditors of their responsibility to the public. The capital markets know that audit quality is not all equal, and they're willing to pay more for reliable audits in the form of reduced financing costs for companies that obtain such audits. The corollary also is true. Markets demand a premium cost of capital from companies that present an audit report that is perceived to be less reliable. This proposal is a way to use the motivating power of our markets to incentivize higher quality audits. But to do so, the markets need information. If the public knew about partner history, the relative extent of involvement of other firms that have their own records of good or poor auditing, the market could react by appropriately pricing the cost of capital. This makes intuitive sense, but studies also show that disclosure of the name of the audit engagement partner has made a difference in foreign markets. Our inspections are instructive as well. Based on more than 10 years of experience, PCAOB inspections have revealed that even within a single firm, and notwithstanding firm-wide or network-wide controls of quality, the quality of individual audit engagement varies. There are numerous factors required to achieve a high-quality audit, but the role of the engagement partner in promoting quality or allowing it to be compromised is of singular importance to the ultimate reliability of the audit. So too, our inspections have found that auditors face and make important choices about how to organize multinational audits. There's no way for an investor to tell today how much of an audit was performed by firms other than assigning firms. In the case, say, of a large financial institution with major operations in 2 or more financial centers, a significant portion of the audit may be performed by other firms. In some cases, the undisclosed auditor has been inspected by the PCAOB, in which case the public inspection report may give the public a sense of the quality of that firm. In other cases, the PCAOB may not be able to inspect the firm, such as in China or a handful of countries in Europe, in which case investors may justifiably want to factor those risks into their conclusions about the reliability of the audit report. Transparency about the partner and the firms involved should, I believe, incentivize the audit firm to organize the audit team conscientiously to give audit committees and investors comfort that it is reliable. I'm grateful for the comments we received on the first proposal. I also want to thank the SEC staff for their assistance and close consultation in this effort. Their comments have helped us shape the new proposal, in particular to refine and focus our analysis on engagement partner identification, and to make the form of the disclosure of other firms that participated in an audit simpler and clearer. Brian Croteau has been a particular friend and carried a laboring oar in this, and I want to thank him, and Paul Beswick, his chief accountant. Commenters have also allowed us to think even more deeply about the relative benefits of requiring the engagement partner's signature. Many jurisdictions do, versus merely requiring disclosure of the engagement partner's name. Requiring a signature could increase the engagement partner's liability exposure. A perceived risk of liability is not necessarily bad, and indeed may contribute to a sense of responsibility. Disclosure of a name, however, should not increase fraud liability for the engagement partner. There's an extensive analysis of our reasons for this in the reproposing release. To me, upon reflection, the comments confirm that disclosure of the name is sufficient to achieve enhanced accountability, to allow investors to judge the engagement partner's record. I continue to think that the compromise reflected in choosing the disclosure alternative, and it is a compromise, is both modest and appropriate. I also believe it is right to provide the disclosure in the audit report itself. The audit report goes straight to investors, as does the request to vote to ratify the appointment of auditors. So why shouldn't the attendant disclosure go straight to investors? I look forward to a new round of public comment. There is a robust record on this proposal. The questions accompanying the reproposal are intended to encourage commenters to think deeply about both their own views as well as the opposing views expressed in earlier comments, and to engage constructively. I will now turn to my fellow board members for any statements they may wish to make. We'll withhold questions, as is our practice, until all the board members have had a chance to make a statement. Then we'll have time for questions and discussions. With that, I recognize Board Member Harris.
Thank you, Mr. Chairman, and I too want to acknowledge and thank our own staff and the staff of the SEC for their assistance in terms of this reproposal. Engagement partner and other audit firm identification have been before the board in one form or another since at least 2008. I have stated my strong belief at past meetings in 2009 and 2011 that this rule would significantly advance the board's mission by increasing both transparency and accountability. So I support its reproposal with the understanding that the board will vote on a final standard in the first half of 2014. The board has heard from numerous commenters over the years that engagement partner identification can improve both audit quality and auditor selection. Our standards make clear that the engagement partner is the person with primary responsibility for the audit. Investors and others have asserted the disclosure of the engagement partner name will produce a heightened sense of accountability for the audit on his or her part, which will lead to more robust auditor behavior and higher quality audits. This is not surprising, given that personal accountability is a foundation of performance in all walks of life. As noted in a January 3, 2012 comment letter from Senator Levin, the chairman of the Senate Permanent Subcommittee on Investigations, disclosure of the engagement partner would strengthen both partner and firm accountability for audit failures. Right now, when a company is found to have engaged in misleading or fraudulent accounting, the identity of the engagement partner is not readily apparent. Making that information publicly available would facilitate holding particular engagement partners accountable for audits they oversee. He goes on to state that because both the engagement partner and the public accounting firm would be identified in the audit report, the current proposal intentionally and clearly signals that accountability is intended to attach to both. And he was speaking about the proposal, our last proposal, which is very similar to the one we are considering today. I believe these amendments will enable audit committees and the market in general to identify the high-quality engagement partners through comparative analyses of engagement partner performance. This identification and analysis should enhance the quality of engagement partners across the board, since they will be conscious of the fact that their work may be monitored and compared with the work of their peers. In addition, since the market will likely exhibit a preference for the high-quality engagement partners over time, audit should improve as a result. I also believe these amendments will bring U.S. audit professionals into closer alignment with their counterparts in other parts of the world and with other public company officials and professionals here in the United States. The European Union, for example, requires its member states to compel the auditor's reports to be signed by at least the statutory auditor or auditors carrying out the statutory audit on behalf of the audit firm. The Sarbanes-Oxley Act includes a number of provisions that are meant to increase the accountability of the senior executives of public companies, most notably, as you mentioned, Mr. Chairman, the Principal Executive Officer and the Principal Financial Officer certifications. Today, company senior executive officers sign their names not only to Section 302 certifications, but also to other documents filed with the SEC. Further, the majority of the Board of Directors must sign their names to their company's Form 10-K and offering documents. The principle of accountability extends to most professionals in the U.S. who are clearly identified under federal or state law. For example, tax accountants sign tax returns, and engineers and architects sign their engineering and architectural designs. It's hard to understand why auditors should be held to a different standard. There are many reasons for the disclosure of other auditors involved in an audit of a multinational company, as Lisa's already outlined. Without that information, one doesn't know who participated in the audit or to what extent firms beside the firm signing the auditor's report did so. By disclosing the other auditors involved, investors in the markets are able to learn whether the other firms are registered with and inspected by the PCAOB. In addition, they are able to evaluate the firm's professional record and practices, any PCAOB inspection findings, and any disciplinary actions taken against the firms by the board or other regulators. It is not surprising that investor surveys here and abroad have agreed the disclosure of the involvement of firms that do not sign the report is essential. The proposed amendments will require the auditor to disclose in the auditor's report the name, location, and the extent of participation as a percentage of the total hours of other independent public accounting firms involved in the audit. The amendments will also require disclosure about the location and extent of participation of persons not employed by the auditor who took part in the most recent year's audit. Also, the amendments require the names of individuals who performed at least 5% of the audit work. These measures strike the appropriate balance between providing investors and other interested parties with the information they need about the conduct of the audit and ensuring that they receive only the most pertinent information, which is why I support them. The Board has also given careful consideration to the potential liability implications of requiring the disclosure of the engagement partner's name in the auditor's report. In our 2011 proposing release, the Board solicited comments specifically on the liability implications of the engagement partner disclosure approach in light of the United States Supreme Court's 2011 decision in Janus Capital Group. The reproposal before us today has carefully considered developments in the case law since 2011 and the comments received. The release articulates the Board's analysis on the reproposal's potential liability implications under Section 10B of the Securities Exchange Act of 1934 and Section 11 of the Securities Act of 1933. As the release notes, the disclosure of the engagement partner's name should not affect the status quo as it relates to private liability under Section 10B. In other words, firms will continue to be liable in fraud cases, and the engagement partner's liability should not be increased. As to any potential liability under Section 11, ultimately, this depends on the SEC's decision as to whether engagement partners and participating accounting firms must file separate consents and whether Section 11 liability should apply in these circumstances. As stated in the release, our proposed amendment assumes that engagement partners and participating accounting firms named in the auditor's report will have to consent to the inclusion of their names in the auditor's report pursuant to Section 7 of the Securities Act and therefore be potentially liable under Section 11. While some commenters have counseled us to hold off on these amendments for the case law under Janus to develop, such an action would be counter to the Board's mission and recognition of the benefits served by having the engagement partner and participating accounting firms identified in the auditor's report. The Board plans to remain vigilant in monitoring how the case law develops, and of course we can revisit this issue at any time in the future. Finally, I believe the release appropriately discusses the economic rationale and costs as well as the alternatives considered in crafting the rule, as well as considerations relating to the audits of emerging growth companies required by the Jobs Act. The release also takes into account various research studies on the disclosure of the name of the engagement partner. As the release states, the new disclosure requirements will not be costly for accounting firms to implement, including those firms that audit emerging growth companies, since we are asking audit firms to divulge information they already know, the names of the engagement partner and the names and locations of other participants in the audit. As Justice Brandeis stated, sunshine is the best disinfectant. I support these amendments because I believe investors and others deserve to know the names of the engagement partner and other firms participating in the audit. I also strongly believe that the increased transparency and sense of accountability on the part of the engagement partner will benefit investors, audit committees, and the market at large. I also agree with commenters that this enhanced sense of accountability will result in improved audit quality. And as with all of our proposals, I welcome comments relating to the release we are considering today. Thank you, Mr. Chairman.
Thank you. And I would like now to call on Board Member Hanson. Mr. Hanson.
So Mr. Ferguson's not going ahead of me this time? Interesting.
Variety.
Thank you. I've got a statement I'm going to read parts of today. The board is reproposing today amendments to its standards to require firms to disclose in the audit report the name of the engagement partner and to provide certain information regarding other persons and independent public accounting firms that took part in the audit. While I support gathering additional feedback on our possible courses of action, I do have strong reservations about today's proposal and take exception to a number of the generalizations in the release about what the board believes. I cannot say today that I would support the ultimate adoption of the reproposal as currently drafted. As is the case with all of our regulatory activities, there is a balance we must achieve. We must weigh the potential benefits of our actions, determining the degree to which they have a positive effect on investor protection, and we must consider the anticipated costs to those that we regulate in the capital markets at large. We strive to base this consideration on the best evidence available. In some cases, the scale tips easily, and the board unanimously supports a new standard. In other cases, it is a much closer call, and this is one of those situations. Many investors have told us they would find useful the information we are proposing to require, including the identity of the engagement partner and other participants in the audit. Some investors believe that knowing the firms involved in the engagement partner's identity will help them evaluate the audit's quality, while others believe the identification will enhance accountability of those leading and participating in the audit. I support investors in their desire for relevant and meaningful information. If investors want to know who is responsible for the audits of the companies they invest, they should have access to that information. If they believe that it is important to understand what other firms or individuals participate in the audit, then we should provide that information, as long as it does not impose unreasonable costs, uncertainties, or other adverse consequences. What troubles me today about this proposal, however, is the mechanism for the disclosure. In the 2011 proposal, we raised questions about whether auditors should disclose the relevant information in the auditor's report or in the firm's annual filings with the board, known as Form 2, or both. Today, we are issuing a reproposal to require all the disclosures in the audit report. In my view, requiring these disclosures in the audit report, as opposed to on our website or in a firm's annual filing on Form 2 or another filing, involves substantial uncertainties and potential unnecessary risks. I believe that the evidence cited in the release for the potential benefits of the disclosures is weak, and certainly the incremental benefit, if any, from including the disclosure in the audit report rather than in another filing is minimal at best. Nevertheless, because I support the concept of increased transparency overall and believe in the process of seeking further input, I agree to the issuance of the reproposal. I am hopeful that we receive robust and thoughtful comments to help guide us as we further consider the best approach to responding to investor calls for more relevant information about the audits. So I'm going to turn to the details on other firms and individuals. With regard to the disclosure of the other firms and individuals, the board is reproposing amendments to PCAOB standards that would require firms to disclose in the audit report participation in the audit by another independent public accounting firm and individuals not employed by the auditor, as well as their locations and certain information about the work performed by those other firms or accountants. As noted in my statement in support of the original proposal, the disclosures are particularly important in the context of audits of companies with multinational operations. In such audits, the auditor issuing the audit report frequently refers certain audit procedures to firms or accountants located in other countries. In most situations, the auditor performs certain procedures to review the work of the other firms or accountants and assumes full responsibility for that work. Currently, investors have little or no information about whether other firms or accountants participate in such audits or about the identity or role of such other firms or accountants in conducting the procedures that ultimately support the opinion. In some cases involving multinational audits, the other firm is unrelated to the firm issuing the opinion, In other cases, the firm issuing the audit report to the other firm are members of an international network, which may be subject to the same or similar governance and quality control procedures. In general, I believe information about other participants in the audit is meaningful information that we should provide to investors. While the percentage of hours may not fully capture the actual importance of the other firm or other accountant's role in the audit, it may provide more insight to investors, and I believe it comes at a reasonable cost to firms who generally track audit hours or should be able to provide estimates and ranges as required in the proposal without too much difficulty. Nevertheless, I'm particularly interested in comments about certain aspects of the proposal. First, is the 5% the right threshold? The increase from 3 to 5 is a response to comments that the 3% was too low. But 5% is not a magic number and not based on evidence that the work of another auditor becomes particularly material at a given point. Would 10% or another level be more appropriate? One reason to consider this threshold carefully is that audit firms who are individually named in the audit report will have to provide their consent to be named as an expert pursuant to Section 7 of the Securities Act. Conceivably, the logistical challenge of obtaining relevant consents from foreign firms could be significant. We have not fully explored this issue, and I hope we will receive meaningful input on these points. In addition, we have posed questions in the release about the potential disclosure of specialists. As written, disclosing a specialist will reveal the same information as disclosing individual accountants participating in the audit. In other words, the specialist will not be named or identified as a specialist, but the audit report will include him or her as a person participating in the audit, but not employed by the signing firm, along with the respective audit hours. But is the percentage of audit hours meaningful for this subset of participants, especially since their contribution of specialized skills could be critical to the audit while the hours are few? Should the nature of each specialist's work be disclosed, or do the hours suffice? What other effects could this disclosure have that the board should consider? Another topic I'll turn to is the circumstance of individuals or firms participating in the audit in the context of so-called offshoring arrangements, which also pose a difficult question. Currently, the proposal takes a bright line approach. If the offshored entity is part of the firm signing the audit report, for example, an office or service center of the firm located in another country, no disclosure would be required. But if the service center is created by a signing firm as a separate legal entity, for legal or tax reasons, for example, then disclosure about its involvement in the audit are required. While this approach provides better clarity about when the disclosures are required, it doesn't provide useful information to investors. Are entities that are wholly owned and controlled by the signing firm but legally separate entities really any different in terms of the work performed? This is an issue I believe would benefit from more comment and consideration. Finally, I am concerned about the potential liability implications for other firms that would be named in their audit report under the reproposal, particularly with respect to liability under the Securities Act. Because firms who contribute more than 5% of the audit hours would be named as experts and provide consents, they'd be subject to liability under Section 11 for material misstatements or omissions in the report. This liability currently does not exist for firms that participate but are not named in the audit report, and I believe this is a potentially significant cost that may weigh in favor of making these disclosures elsewhere. Because these liability concerns overlap with my liability concerns about engagement partners, let me first say a few words about that aspect of today's reproposal. As the staff has explained, the board is reproposing today a requirement for firms to disclose the identity of the engagement partner in the audit report. My concerns about this aspect of the proposal are significant because, based on what we know, I believe the potential costs associated with requiring this disclosure in the audit report may far outweigh the more limited benefits. Investors have told us that they believe the identity of the engagement partner is meaningful and relevant information. Some investors have told us they believe identifying audit partners will enhance the accountability of those partners and therefore enhance quality. I am skeptical of this, and the board has found no evidence that indeed such an effect is likely. Indeed, the release cites several studies suggesting that disclosure of engagement partner's name produces limited or no observable improvement in audit quality and offers no studies to the contrary. The work of the public company auditors is governed by performance standards and is reviewed by engagement quality reviewers and internal firm inspectors. They also have PCAOB inspectors judging the most difficult aspects of their work. They understand with every issuance of an audit report, their firm's reputation is on the line. Ultimately, those individuals who stray from their obligations despite all these incentives may face the specter of regulatory enforcement proceedings and the subsequent loss of their ability to practice in their profession, as well as civil litigation. Accountability for audit engagement partners, in my experience, is already built into the system. Other commenters have told us they believe that knowing the identity of the engagement partner will permit them to evaluate the quality of the audit, particularly after some period of time has passed, allowing for the accumulation of information about engagement partners and their audit experience and history. I do not question the desire by investors to have that information and believe they should have access to it as they see fit. I do believe, however, that in order to justify regulatory action, the benefits referenced in today's release need further expansion and support, and I'd like to better understand how information about engagement partner is used by investors today in jurisdictions where the information is currently provided. I also believe that the engagement partner's identity alone will provide only limited insight into the quality of an audit. While engagement partners certainly have significant responsibilities under applicable auditing standards, in practice they are not solely responsible for the quality of an audit. Many firms have complex quality control systems. Large engagements often include multiple partners involved in supervising and reviewing the work of the firm's staff, as well as partners and foreign affiliates. Engagement partners frequently consult national office experts to help resolve technical questions, and many firms have policies requiring engagement partners to follow national office determinations on such technical questions. Thus, while the engagement partner plays an important role, he or she by no means is the only factor in audit quality. Nevertheless, while the benefits of learning engagement partners' identity may be limited, I understand the investor's desire for more information, including the engagement partner's name. I'm not opposed to providing that information in some form, but have significant reservations about whether the disclosure of the information should be made in the audit report rather than through other means. When we issued our proposal in 2011, we asked a series of questions about the potential increase in liability to engagement partners that would arise out of the disclosure of their names in the audit report. My concerns at that time included not only the potential for some limited number of engagement partners would face significant personal liability, but also the imposition of such liability could make the auditing profession less attractive. This could provide a disincentive for the best and brightest young accountants to become auditors at a time when financial statements are more complicated than ever. In addition, such potential liability could cause defensive auditing, resulting in unnecessary audit procedures and increasing audit costs, but not necessarily increasing audit quality. Based on the limited feedback we received in response to the original proposal, we know little more about this topic today. What appears clear is that engagement partners, as well as other firms proposed to be named in the audit report, would be subject to Section 11 liability under the Securities Act for any material misstatements or omissions in the audit report because they were named as having prepared or certified any report or valuation that is used in the connection with the registration statement. The extent to which this would spark additional litigation against engagement partners or other named firms and would affect their ultimate liability remains unclear. Potential engagement partner liability for fraud under Section 10B of the Exchange Act and the SEC Rule 10b-5 likewise is uncertain. While the release attempts to explain the importance of the Supreme Court's Janus decision and suggests that proposed engagement partner disclosure is unlikely to change the status quo regarding private litigation for fraud, the release also concedes that it is unknown how the courts will interpret the Janus decision in the context of engagement partners. The release goes on to state that the uncertainty does not, in the board's view, justify depriving investors of the benefits of the additional information that would be provided pursuant to the reproposed amendments. That, however, is not the dilemma we are facing. The question is not whether we should deprive investors of the relevant information, but about how best to provide the information while doing the least harm. In my opinion, requiring the relevant disclosure in the audit report as opposed to finding another disclosure mechanism is the wrong approach. On the other hand, I would support the required disclosure of the name of the engagement partner and other participants in the audit through one or more of the alternatives described in the release. Personally, I believe the best place for this information would be in the Audit Committee report, where the Audit Committee could expand on the information to provide additional context to its selection of the engagement partners and its oversight of the audit firm. We do not have the authority to require Audit Committee disclosure, but I believe this would be an appropriate topic for consideration by the SEC while respecting its already very full agenda and understanding that any formal action would take time. In the meantime, I'm encouraged by a recent call to action by the Audit Committee collaboration, encouraging audit committees to enhance their disclosures, including by providing context about their selection of the lead audit engagement partner. I would like to see the disclosures we are considering today added to the action call in order to provide relevant information to investors more quickly than any standard-setting project by the PCAOB or SEC could accomplish. Barring SEC action, I would also support a PCAOB standard requiring the relevant disclosures in a form to be filed with the board, such as the firm's annual report, Form 2, or another special filing made closer in time to the issuance of the audit report. The release discounts these two alternative approaches because they would require investors to search two different places at two different regulators to see both the auditor's report and the disclosure about the participants in the audit. I find this rationale unconvincing. There's no value to obtaining only the engagement partner's name. In order to make use of that information to evaluate the potential quality of a given audit, investors will still have to look at other regulatory filings, including searching for disciplinary records on the PCAOB website, or do other background research in order to find out relevant information about the partner's experience and history conducting audits. I also believe that the other objections to this approach, such as those related to the ease of use and accessibility of the information on our website, could be easily solved. Indeed, I believe the PCAOB generally should begin to move away from its form-based reporting and static disclosure approach, and over time establish web-based systems that are more easily searchable and feature more timely data to make all of our information more usable for investors, audit committees, and others. Establishing a mechanism to allow a user to search for an issuer, its audit firm, the firm's most recent engagement partner, and other participants in the most recent audit would be the modest first steps in this direction. In closing, I believe the board has more work to do. I believe investors will gain some benefits from the disclosures we're proposing today, and do not believe that the disclosure should be made at all costs in the auditor's report. As noted in one qualitative analysis on engagement partner identification that is cited in this release, and I'll quote here, relevant academic findings do not provide the basis for making strong inferences about this issue because the data are scarce and inconclusive. However, given the research, the PCAOB's implicit assumption about unconditional benefits of increased transparency and accountability is inconsistent with the empirical evidence. Both increased transparency and increased accountability have a positive impact only in a certain set of conditions, while different circumstances might lead to adverse outcomes. I believe we need to do a more thorough job considering the potential adverse outcomes of putting these disclosures in the audit report. Ultimately, I believe that work may lead us to conclude that disclosures should be made through another mechanism. Short of that, I doubt I'd be able to support a final adoption of the standards as currently reproposed. Substantive disagreements aside, I do want to add my thanks to the staff for all the hard work they put into this, the Office of the Chief Auditor, the General Counsel's Office, the Office of Research and Analysis. I appreciate this has been a difficult and long slog, and the tensions it has created are great. So thank you for your time and effort, and I'd also like to thank the SEC staff for their enduring patience with us and their comments that have been very helpful. So I'll turn it over to my next board member.
Board Member Franzel.
Yes, we're switching up the order here. Thanks, Mr. Chairman. Before the board today is a two-part proposal that would require disclosure of the name of the audit engagement partner in the audit report and the names, locations, and extent of participation of certain other accounting firms and persons not employed by the auditor that participated in the audit. And I'm going to talk about each aspect of this proposal separately. I'm pleased that we are considering a reproposal instead of an adopting release as originally planned earlier this year. In my view, a number of fundamental questions need to be addressed before we can conclude on any final standards in this area. And those questions need to be properly addressed with appropriate evidence and analysis, and I don't believe we're there yet. Robust disclosure is the cornerstone of U.S. securities regulation and supports efficient capital formation and allocation. So mandatory disclosure and transparency can be an effective regulatory approach to addressing an identified need or identified problem. I fully support the principles of disclosure and transparency to provide investors with information needed to make informed investment or voting decisions, reduce information asymmetry, and promote responsible and accountable behavior on the part of individuals and organizations. But the key questions surrounding today's proposal are whether and how additional transparency about the identities of engagement partners and other participants in audits would solve a particular problem, and how it would serve appropriate policy objectives, achieve certain benefits, and to what extent it would impose compliance or other costs. Frankly, it is very surprising that we are at this point in the standard setting process with such basic questions still unanswered. Regarding disclosure of the name of the audit engagement partner, since the board began exploring this issue in 2005, The identified objectives of the problem have shifted and changed over time, making an evaluation of the relevant evidence and alternative approaches difficult with the information that we've gathered so far. The board first explored requiring partner signature with an objective of improving audit quality. The approach was to provide information on the partner name to investors who could influence the selection of auditors and to incentivize auditor behavior through their signature as well as identification by increasing auditors' sense of personal accountability. Today's release states that the primary benefits of the current proposal pertain to disclosure and that this information would somehow be useful in investment decisions. The release also suggests that such disclosures may create an incentive for auditors to voluntarily take steps that could result in improved audit quality. But whether disclosure of partner name would increase audit quality through increased accountability remains an open question, despite what we heard as recently as a few weeks ago from members of the board's investor advisory group who said that an enhanced sense of accountability is their primary continuing interest in obtaining an engagement partner's signature on the audit firm's report. Today's release does not explain why the board has changed its objectives from accountability to disclosure of partner name being primarily useful for investment decisions. And with those changed objectives, the board is in a position of surmising how such information may be compiled and made useful over time. Thus, we find ourselves in a situation of asking basic questions in this reproposing release that would be expected in an initial release or even a concept release. We're asking questions such as whether naming the engagement partner would be useful, how would it be useful, and information about related costs, including the potential for increased liability. As a result of our current lack of evidence and analysis to provide answers to the above questions, many of the conclusions in the release are based on speculative beliefs, and therefore I cannot agree with them. And many of those conclusions are attributed to the board. At this point, naming of the engagement partner in the auditor's report seems to be a solution that is looking for a problem. First, the objectives of this project are difficult to define over its various iterations. Second, the current release does not articulate how the proposed solution addresses any particular problem, nor does it present an analysis of benefits that is supported by data and evidence. Finally, many questions remain unanswered related to potential costs and liability issues. Still, I'm open to exploring this concept of naming the engagement partner and to using this reproposal process as a basis for gathering information and conducting a solid analysis of these issues. Regarding the naming of other firms participating in the audit, in my view, the board has a much better supported case for this aspect of the proposal. My views are based on information and analysis gathered through the course of the project and the consistency of this proposal with the audit firm level accountability provided through PCAOB Oversight. Presently, only the primary audit firm is named in the audit report, even though other firms may contribute significantly. Requiring disclosures of the names of other firms may be useful to investors, particularly if these firms are in jurisdictions where PCAOB is currently prevented from conducting inspections or investigations of these auditors. In light of PCAOB's oversight responsibilities, the board has deemed it in the public interest to provide investors and others with information about those jurisdictions where the PCAOB is prevented from inspecting the U.S.-related audit work. An audit firm in a country that does not allow for PCAOB oversight could be participating in an issuer's audit with little or no transparency being provided to investors. So providing transparency about these other firms and other participants seems salutary in these cases. Disclosure of other firms and participants in the audit is generally supported by information and analysis that we gathered during the course of this project. However, fundamental questions remain regarding this proposal as well. For instance, today's reproposal calls for disclosing information about other participants in the audit if the contributions of those persons exceed 5% of the total hours in the audit. Some of those firms that meet that threshold, that proposed threshold for disclosure, may not be registered with the PCAOB or be subject to PCAOB oversight if they do not meet the threshold for playing a substantial role in the audit and do not perform other audit work that is within PCAOB's oversight. Would disclosure of information about the name of firms not registered with the PCAOB provide useful information for investors? In addition, what are the costs and logistical implications for the lead audit firm in obtaining the consents needed to disclose information about other firms? What would be the consequences to the issuer and the lead audit firm if consents were not provided by these other firms participating in the audit? We also have a number of unresolved liability and related cost issues related to both proposals. Audit firms that issue audit reports and others that participate in the audit can already be accountable for their work under a variety of legal theories. Here again, the release contains conclusions about the potential exposure of audit firms to additional third-party liability without conveying detailed supporting information or analysis. The release contains a conclusion that the board believes that any possible increases in a named engagement partner or participating accounting firm's exposure to liability should be limited, and that the potential risk of such increase would be justified by the potential benefits to investors and other financial statement users of greater transparency. And I believe we need more analysis to support such a conclusion. The release does not fully explain the evidence and theories related to the potential financial costs of such additional liabilities. I encourage commenters to share their views and any additional available evidence relevant to the benefits and impact of these questions and alternatives considered by the board. Finally, in my view, the release does not contain a robust evaluation of alternative approaches to responding to calls from investors and other stakeholders for information about the key participants in the audit. For instance, is the audit report the proper place for disclosure of the audit engagement partner name or other participants? Is additional context needed for this information to be valuable to investors? Would the information be more useful to investors if placed in the audit committee report in the proxy statement, along with additional context about the audit committee's oversight of the audit? Would this information be better placed in a user-friendly application on the PCAOB's website? The board originally proposed to require audit firms to disclose the name of the engagement partner for each audit report in the annual report filed with PCAOB on Form 2. As noted in the proposing release, doing so would make that information available in one place that could easily be retrieved, since such reports are posted on the board's website. I encourage commenters to share their views on possible alternatives to responding to investors' calls for information on the factors that would be relevant to assessing the merits of various alternatives. We need to consider these issues in a holistic manner. The reproposing release before us today asks 25 detailed questions on a variety of aspects of the reproposal, including many of the basic questions that I discussed today. I believe this reproposal can provide an opportunity to clarify these matters and gain additional evidence and perform analysis. I am concerned that commenters are being given only 60 days to consider such a large number of fundamental questions, especially as we approach the holiday season and the busy season in financial reporting and auditing. I would like to thank the staff for their hard work in developing this project. I know it's been a very long haul for all of us, and for asking the detailed questions that are posed in the release so that we can gather more information and evidence needed. I fully support an exploration of the issues surrounding the potential disclosures discussed in the release so that a full analysis can be performed to support an appropriate outcome. Thank you.
Thank you. With Board Member Ferguson having performed an extraordinary task of counseling and then drafting on this release, I think you get the last statement, Mr. Ferguson.
Thank you, Mr. Chairman. I have a written statement, but rather than reading it, I'm simply going to talk here. And I think in listening to the board members here, you see some what may be philosophic differences in the way we look at these problems. So I want to give you my own overall views of this whole project and how it fits into a larger agenda at the PCAOB. I think one of the questions you could ask is, since you've been at this since 2008, why are you reproposing it? Can't you people make up your mind about this project? I think it makes sense to repropose it, however, for several reasons. One, the law on liability is developing. Secondly, academic literature is developing because other countries have begun to adopt engagement partner disclosure requirements, and people are beginning to look at that and its effects of it. To the extent we have more information on this, it's better in making these decisions. And finally, in 2012, with the adoption of the Jobs Act, regulators are now required in putting out rulemakings to look at the consequences for emerging growth companies of the regulations, and particularly with respect to efficiency, competition, and capital formation. We need to do that. It gives us a good chance to do this. It gives us a good chance for our economists to sort of show their skills here, and I think it makes rulemaking better. So I support the reproposal. But I am eager to see us move forward with this. The way I look at this project is that it is part of a larger project by the PCAOB to cast more light on the audit process for the benefit of investors and other users of financial statements. Up to now, I think to too great an extent, investors in looking at the audit and the process of the audit have had to view it through a glass darkly, as the Bible says. They've had very little transparency into who performs the audit, what the audit work is, what the auditor thinks, what the auditor knows. Audit committees have known this. Audit committees have access to it. But investors, who after all are the owners of the company, do not have access to that information. And I believe this project, along with our revised auditor's reporting model, our attempts to make our summary inspection findings communicate more useful information with greater clarity to the public will be useful, as well as our outreaches to investors and audit committees. So I'm supportive of this project, but as part of a larger goal by the PCAOB to increase the transparency of the audit. Now let me note several things about this particular proposal. One thing, it requires the disclosure of the name of the engagement partner in the audit report. I strongly support doing that for several reasons. One, I think that it is easiest for investors who are looking at the primary documents they look at when they first look at a company. And I use my own experience for this. As someone who owns shares, when I first look at a company, the first thing I look at is the 10K, the proxy statement, and the annual report that comes out. If the audit engagement partner's name is included in the audit report, I see that in one place. If I have to go to the PCAOB's website to look at that, I think I'm very unlikely to do that. And having gone back and looked at how many times our website is hit normally in a year, with people looking at the various forms that are filed here, I am not encouraged at all that disclosure on our website would be useful to the average investor. I'm also aware of the fact that disclosure of the audit engagement partner's name alone, initially, probably won't provide very much useful information. What does a name give me? I do think, over time, however, that information will be gathered about these auditors, probably by third-party information providers, including things like the history of the public, the track record of that auditor, the public companies the auditor has been involved in, whether the auditor has been involved in public disciplinary proceedings or litigation that's public, or been involved in restatements that have resulted in public information, including also information about the professional activities of the auditor. This would be useful information, I believe, to investors. We certainly know that increasingly information is available about other professionals, doctors, lawyers, and that consumers widely use the rating services and the information services about other professionals. I don't know why it would be any different about auditors. With respect to other firms, I would agree with what my colleagues have said about the disclosure of other firms, but I have certain other thoughts about it as well. Jay asked the question, why is 5% the appropriate number, or 3%? Any number is arbitrary. There's not any magic number we could pick. Any number will be arbitrary. The reason I think 5% is reasonable is that it's a significant amount. Above that, we require disclosures in ranges, usually in 10% additional increments. One of the things that I believe over time will be useful to investors about that kind of information is that if you're looking at this and you go back and look over time and suddenly you see a spike or a decrease in the audit work done by a particular auditor in another country, that gives you a clue as to the business of the issuer, not just the auditor. Why was the auditor concerned with this? Why did audit work go up dramatically in a particular country? Does that lead to questions that you might want to ask? That information isn't available today. No one knows that information except the audit committee. And I believe this will be useful information potentially. In addition to which, you can then find out whether there are inspection reports of those companies, of those participating auditors by the PCAOB, or whether, in fact, as the chairman said, we're barred from going to those countries. All of that, I believe, would be useful information. We are aware and we have assumed for purposes of our analysis that by putting the names of both the engagement partner and the participating firms in the auditor's report, that those people would be required to file consents to the use of their names with the Securities and Exchange Commission, and that will make them subject to Section 11 liability. If the SEC wants a different result, that's their business. But for our purposes, we have assumed that this will be the case. I do note, however, that this does not in any way, shape, or form, except for the filing requirement, increase the performance obligations, particularly with respect to the audit, of any of these parties, nor should it, in the case of securities litigation, increase the aggregate liability. There's extensive analysis of the liability and potentially liability issues in this proposed release, and I am satisfied that the better argument is that liability should not be increased. One other thing that I want to point out about the naming of the engagement partner is that it moves us into conformity with what the increasing practice in the rest of the world is. The European Union already requires disclosures of the auditor's name. Australia requires the auditor to sign the audit report. The International Auditing and Assurance Standards Board now has a proposal out that would require disclosure in the audit report of the engagement partner's name. If that is adopted, as it's likely to be, that will become binding on the countries, the many, many countries around the world that will follow those standards. If we don't move in this way, the United States will be an outlier, and I don't think we should be an outlier on something like this. We've asked many questions. We're very eager to hear what people think about this, but I strongly support this proposal and hope we move forward. And in closing, I want to thank the hardworking staff of the Office of the Chief Auditor, the Office of the General Counsel, and the Office of Research and Analysis, who've been engaged with this project for 4 years. And I want to welcome, I think, the first really significant engagement in one of our projects by the economists here, and that their work has been really terrific and very helpful to us. And as usual, I want to thank the staff of the Securities and Exchange Commission who've provided thoughtful comments on the draft and on the project as a whole. It's been very helpful, so thank you, Mr. Chairman.
Thank you. Question time. Mr. Harris, questions?
Well, I'd like the staff to please discuss your thoughts in terms of how the name of the engagement partner and other firms participating in the audit of issuers is useful to the PCAOB in our oversight activities.
I'll start with that, and Jennifer will, I think, add some more. Right now, when the PCAOB inspection process is largely a risk-based process trying to determine which audits to inspect. Many factors go into that risk-based process in selecting audits, but clearly one of the most important is particular engagement partner history. For us, we know if we inspected an audit before about that partner and it was a poor performance, we're going to go back and look again at that partner's performance. But also, and that would be available to us, but that's not necessarily available to others. But information that is available to us that would be available to others, for instance, is we can see if a partner historically has audited small manufacturing companies and is now being tasked with a very large multinational financial institution. That change in responsibilities could create a risk in terms of the audit of that entity based on a particular person's experience. That is a factor we consider in our selections. And investors would now be able to know over time, as Board Member Ferguson pointed out, what type of industries has that partner historically looked at, and does he or she have experience in some other very complex industry where he is now or she is now being tasked to do work. So I think there's a lot of ways in which the history of the engagement partner factors into our selection of audits to inspect, and I think it will factor into investors' understanding of the engagement partner's history and performance, including restatements, as mentioned, or other disciplinary actions. Are there other factors, Jennifer, that maybe I've left out?
An engagement partner, I think you covered it. Steve also asked about our other firms and why we think that how we use that information.
Not only that, but how you think this might be useful to investors overall and other users of the financial statements. And finally, I would say, in terms of one of the comments here, the investors the board has heard from overwhelmingly support naming the engagement partner in the audit report for reasons I think that Lou has articulated, at least in his comment. But if you could answer the question, I'd appreciate it.
Did you want me to start with the other firms?
Yes.
Or okay. As I've mentioned earlier, we've seen that other firms, the auditor signing the report can use other firms to perform practically almost all of the audit. So even though they're signing it, they may have done very little of the audit work. We've seen variations ranging from none to practically most of the work done by other firms, which has been significant. As we've seen in our own inspection reports of firms, audit quality varies among firms. Even within a firm-wide, network-wide system, we see variations among firms. We also, as it's been mentioned, are not able to inspect in some of all those countries. And we have found that information very helpful in looking at risk-based, focusing on our inspection process, and we think that same information will be very useful to investors, because otherwise today, an investor would have the perception that all the work was done by the signing firm, when in that in fact was not the case. So we think that'll be extremely valuable to investors, as it's been for us. Engagement partner, you are correct. Overwhelmingly, investors have indicated that they want transparency about the engagement partner. That has been resoundingly clear throughout the many years of outreach that we've conducted, the meetings of the IAG, meetings of the Standing Advisory Group. That has been a consistent theme throughout. We do think providing the name will be very useful. I might turn it to Andres as well, because we have, and it's also been mentioned, academic research. There's been a body of data that's come out looking at studies in the UK, in Taiwan, in Sweden, in other countries that have the engagement partner signature requirement. And those studies have found that it's also useful to investors. And so that's been an important consideration in connection with our recommendation today to recommend reproposing. I think since I teed it up, Andres, if you could elaborate on that a little further, I think that would be helpful.
Sure. The proposed standard would provide information to investors and other stakeholders in the audit that corresponds to the relevant unit of the transaction. So investors could use this information to make decisions. By way of analogy, we can point to the market for automobiles. Imagine buying a car based only on the reputation of the manufacturer. Brands matter, but information is not granular enough. We need to know something about the particular make of the car. Publications such as consumer reports help buyers distinguish the difference in quality between different makes of automobiles, helping consumers make more informed decisions. Other professions have similar disclosure requirements. I'm thinking about lawyers, engineers come to mind, sell-side research analysts in Wall Street. Consumers differentiate and care a lot about difference in quality among individual analysts in those professionals. And these professionals, in turn, value this transparency as important ways to differentiate themselves as professionals and enhance their career through enhanced performance. Finally, there's evidence that financial markets in general react to information in quite an efficient manner. Sometimes this information is rather obscure, but markets seem to react anyway. Nobody knows exactly what the future holds, but it is reasonable to assume that markets will also react over time to the identity of leading partners. As the chairman mentions, investors might pay more for issuers with more reliable audits. Indeed, academic work and papers seem to indicate that at least in some countries that is the case. We do welcome comments by the public on studies, information, or more empirical data on these matters.
I think in summary, Mr. Harris, both in our inspections process with respect to other engagement partners or other firms, it's very important information as we evaluate an audit and evaluate how to inspect it and who to inspect. As I said, with respect to the engagement partner, we have seen cases where an audit report was signed by a U.S. firm, but the vast majority of the work, up to 90%, was done by a firm in a country where we couldn't inspect. That was not transparent whatsoever to investors. The disclosure of the other name would be very valuable. Again, with respect to the engaged, so that's with respect to other firms and multinationals or in those kind of situations. With respect to the engagement partner, that history is very important to us as we select audits to inspect and assess the riskiness of audits. And I think over time, a body of information will be developed, which will give investors that similar type of data to help them assess the quality of a particular audit.
Thank you.
Mr. Hanson, any
I don't
questions?
have any questions.
Ms. Franzel, any questions?
I raised a number of fundamental questions in my oral statement and in my written statement, and so I'm hopeful that during this process we can gather sufficient evidence and analysis to address those questions. And so I don't have any further questions today.
Mr. Ferguson.
Yeah, Marty, I'd like to ask you a question about how this reproposal impacts specialists, and specifically, I have some specific questions. One, will their names be disclosed regardless of the percentage of the hours they contribute? Will their names be disclosed individually or by firm? And do you anticipate that they would be required to sign consents to the inclusion of their name under Section of the 1933 Securities Act?
So specialists would not be separately named as part of this reproposal. The hours that specialists perform in an audit, whether they're employed by a firm or they're engaged by a firm, those hours would be part of the total hours to be performed, to be included. And then to the extent to which they were not part of the firm, if they were separate entity or a separate individual, they would be disclosed either as another accounting firm performing work with the percentage of the hours, or other persons not employed by the firm, but they would not be disclosed by name. So their hours are part of the calculation and determination, and they're included in other persons not employed by the firm in disclosure if it's an engagement, but there's no naming of the specialists and therefore no consent requirement in our view with respect to that. That is a change from the original proposal where we did require names to be included, although we excluded at that time in the original proposal specialists because of concerns that smaller firms are the ones who largely engage specialists. Larger firms typically have them on staff, and therefore only smaller firms would be naming those specialists. And so we were concerned that maybe that would put the smaller firms at a disadvantage. And so we didn't include the requirement for engaged specialists to be included in the calculation of hours in the original proposal, but they are in the calculation of hours and in the participation here, but not designated as specialists.
Thank you.
I hope that's clear.
Yeah.
Well, I have a couple. First, discussions from the board about other places, other venues where information about transparency in the audit might come, and it might, in the view of some board members, be even more appropriate, such as the audit committee's discussions in the proxy statement or the action call publications. We have the Vodafone proxy statement now, in which there's a very extensive discussion by the audit committee of its rationale for engaging its auditors. The question is, nothing we do today prejudices, stops, prevents, limits in any way adversely affects any disclosures that a board or its audit committee might wish to make or that other regulators might require, does it?
It does not. I agree that we are seeing proposals and actions in some other countries in connection, the UK in the example you gave, where audit committees are required to have a more robust discussion of engagement partner and hiring of the firm and things of that nature.
And indeed, that can include an audit committee being very specific about why the engagement partner it has been identified with some of the most challenging, messiest, difficult audits around, couldn't it?
Absolutely.
I mean, we know cases here, and the public knows cases in which senior auditors have stepped in and performed brilliantly in very difficult situations and forced companies or required companies to go and take extensive write-downs. And their careers have not suffered from that, and indeed they're still very much in demand, are they not?
Yes, they are.
Then there is also Section 11 liability, which has been mentioned several times. Section 11 liability, of course, is different because it is strict liability. But it has always had what we call a due diligence defense. One who is defending their actions under Section 11, having filed a consent, is always entitled to show that they exercised the due diligence, not complete diligence, not zero defense or no possibility of error diligence, but just reasonable due diligence. That's always been true. The chief auditor, having been a senior auditor on many occasions and many accounts that were subject to Section 11, isn't that the case? I mean, didn't you interpret Section 11's defense as a real defense?
Well, I interpret it as a real defense, but again, I think as an engagement partner, I'll share the fact that if I had to have my name identified or sign the audit report, I don't think that would have troubled me at all in the context of I felt that I was doing the work in accordance with professional standards and I knew what the liability was.
This goes,
I'm just saying that part of this document includes the fact that I have experience in this regard, and I believe such disclosures are appropriate.
And nothing we do in any way limits, detracts from, in any way renders less available the due diligence defense under Section 11, I take it.
No, and it would,
No, I
General
don't think
General counsel gets a...
As you say, accounting firms themselves are subject to Section 11 liability today, and they have a due diligence defense. Nothing in this would affect that.
And I would be derelict in not acknowledging the presence of the chief economist of ORA and asking a question here. And that is, we do cite in a somewhat unusual precedent for regulators. We have an extensive citation of bibliography and articles from academic, econometric, experimental literature in this release. I have actually read some of these, and that, of course, is a danger. And the reason I'm asking is that I want to be sure that, in fact, the chief economist and the economists in the chief auditor's office would agree that in citing these as being strongly supportive or clearly supportive of the meaningful nature, the materiality of this information, the utility to investors, you all believe this is convincing for those propositions. You're not in doubt about whether this is supportive of the proposal or reproposal?
The literature is emerging, and many of these papers are still in working paper format. The academic publication process is a quality control mechanism that is sound but takes many, many years. And indeed, many of these regulatory developments around the world are quite recent. So we're still, the academic community is still looking at these results. Some of them, on the other hand, have already been accepted for very serious publication. I'm thinking about a particular paper about the UK where they do find very strong effects on the act of partners signing their name, producing strong benefits in terms of audit quality, but also increasing the amount of costs. So there's both a benefit, a strong benefit, and a cost. There's other papers which would tend to be in working paper, haven't been published yet, do seem to indicate that there is an effect that capital markets do tend to look at this information about the identity of the partner. I'm thinking about a study on Sweden, a study on Southern Asia that specifically looks at whether investors seem to be taking into account the past history of leading partners. And what they do find is that that information about these partners does make a difference in the investment decision mix, and they found the effects on cost of capital for issuers. These are very, very interesting studies. We're keeping a very close look into them. I think they show that there is an effect, that people do care, do look at it. Some of these effects are quite surprising. I do come personally to this study saying, well, who could care about this? Well, it turns out that markets seem to be moving in those directions, which is quite surprisingly, frankly, to me. But there is an effect. There seems to be an effect. We are looking forward to what the peer review process will say about the quality of these studies. We look at them very closely in our staff. We read them. What we do is we look at them both from methodology and for conclusions. We see whether they fit the larger literature. We look at whether, even taking in consideration that the results might not be as robust as peer review papers might be, where they would help the board in making their decision. And finally, when we note instances where commenters offered valid criticisms to the results of the conclusion of the research paper, we do try to include them in the appropriate document. But at the end of the day, we only do cite research that is solid from a methodological
Well, you raise a very important point here about the reproposal process, the time that has elapsed. If reading one of these papers, for example, and this is the Oklahoma State Scholars paper, I think that's a fascinating paper, but you come away with the sense that many of the problems that he finds in naming the engagement partner and associating the engagement partner with a messy audit is a problem the firm has anyway now, it seems to me. I mean, this is a layman's view of that. But the reason I raise that as an example is that I assume that if we get around to something in the late spring, if we can get something in the spring, we will have had the benefit of having seen the comment process and the peer review process for some of these papers. And I take it that would be helpful on all sides to know what peers think of these papers.
Absolutely.
And I'm also encouraged by the fact that, as you describe it, Andres, it's clear we haven't just been sitting around tuning out. You and your colleagues have been collecting a lot of literature as we've gone over the recent months and in the recent weeks. So you're engaged in a continuous process of looking for academic thought, academic analysis that will help us make sense of what has been very necessarily a short experience with the underlying facts and the underlying data.
Absolutely, and we have engaged some of the authors of these papers, but I look forward to comments, particularly of colleagues in the academic community who might have further ideas on what is going on. Further slicing of the data would be very helpful to the staff.
Well,
I got a final question.
It's unfair of me to engage in lawyers' cross-examination and leading. I've engaged in leading questions of the staff. So with asking forgiveness for having kicked in a few leading questions, again, with thanks from all of us. Unless there are any further questions from the board?
I have a further question, Mr. Chairman. Well, not many, but first of all, I don't assume that there's anything more that you want to add about the movement in the international community regarding engagement partner identification, or for that matter, engagement partner signature, which I know is not on the table right now. I think
the main points have come out, and that is that there is a trend. It's required in the European Union for the engagement partner, the statutory auditor, as you said, to sign. And as you said, there's a proposal from the IAASB, which would include in the audit report the name of the engagement partner. So basically, all jurisdictions around the world, if that proposal were adopted, who follow IAASB standards, would be identifying the engagement partner, or in the EU's kind of case or other places, signing. The audit engagement partner would sign. So I think the point was well made that others are moving in this direction very rapidly, and we'd be an outlier if we're not moving in this direction.
And finally, Mr. Chairman, has been pointed out, this has been before the board since 2005. At least it was first brought up at the SAG in 2005. We had a concept release in 2009. We had the reproposal, or the initial proposal in 2011. Now we've got this reproposal. We're going to have, I guess it's a 60-day comment period. I certainly welcome the additional comments. I welcome the analysis that, Andre, as you said, you're going to devote to this. But Mr. Chairman, are you planning on having a vote in the first half of next year?
Are you willing to cede the rest of your time and cease questions when I answer this? It is important to me that we get this behind us. This is not a proposal in which people don't know what they think, as you've seen from the board. The comment period of 60 days is, in my view, intended, notwithstanding the holidays, which Jeanette points to and which I acknowledge, to make people who have a stake in this and a real interest in it get busy and do their work. It would be, I think, wonderful if we could have a definitive proposal and vote up or down by the end of March. I frankly think that is too aggressive, given everything that has to happen in this board between now and the end of March. It does seem to me that something in the spring, the late spring, is doable, achievable, and it would be a credit to the board and our ability collegially and as colleagues to air our policy differences, to discuss them intelligently and decide where we stand, to do this by the spring. And that means this overworked staff has got to go through the comments. And I think if we are correct in our view that we'll have significant comments, that'll be a real task. Certainly the first half, I think, of 2014 is a benchmark against which we should be measured. If we are sitting here in November and we have been unable with this kind of reproposal, redirection of economic analysis, request, as Jeanette points out, in over 25 questions for hard facts, for data we can get our teeth into, for reflection, as Jay points out, on what it means for the audit profession. If we can't do this and have an up or down vote by the end of the summer, I think we are not doing our job. And I think certainly if we're sitting here in November and haven't acted, people will be entitled to be annoyed. So yes, I think we should start shooting for the end of March to get the work done. If we have to extend the comment period, I think that would be too bad. I think we ought to get with these questions. I would see no reason for that. So I would urge people to take the questions seriously, get the comments in so the staff can go to work on them. If the staff can get a draft of an adopting release with comments addressed appropriately and with the other analysis that you've heard board members ask for reflected, if they can do that by May, they will have done the kind of splendid work I think they're capable of doing. But certainly through the summer, we should get this finished. With thanks to the board members for the kind of I think robust discussion that this meeting has brought, I will ask that all in favor of approving the proposal and the issuance of this reproposal, please say yes. Yes?
Yes.
Any opposed? Hearing none, I believe it is a unanimous reproposal. And thank you all. There's a second agenda item. Members of the public scurrying to the board door are going to have roll taken. This is an important proposal.
A boring one.
Huh?
A boring one.
But less sensational. That's right. Less colorful, but perhaps certainly as important. The second agenda item is a recommendation that the board adopt amendments to its rules and forms. And for that recommendation, we turn to our general counsel's office, Mr. Seymour, Mr. Stevenson, Mr. Meehan.
Thank you, Mr. Chairman, members of the board. Today, the Office of General Counsel is pleased to recommend that the board adopt amendments to its rules, forms, and ethics code to conform them to the Dodd-Frank Wall Street Reform and Consumer Protection Act, which expanded the PCAOB's authority to include oversight of audits of broker-dealers and to make certain technical improvements to these rules and forms in light of the board's experience. Now that the SEC has adopted its amendments to Rule 17A5, and the board has adopted new broker-dealer audit and attest standards with coordinated effective dates, today's amendments would represent the board's next step in addressing the changes that the Dodd-Frank Act made to the Sarbanes-Oxley Act. Before Vince Meehan introduces the proposal, I would like to recognize and thank our colleagues on the board staff for their significant contributions to what, given its scope and the number of rules implicated, truly was a cross-divisional project. First, within my office, I need to recognize Vince Meehan and Nancy Doty for leading this effort. Nancy, unfortunately, cannot be with us today, but it was a collaborative effort, and I'd like to particularly mention Michael Stevenson and Bob Burns for their significant contributions to the release before you. For other divisions, I'd like to particularly thank Jerry Decker and Bill Ryan from the Division of Enforcement and Investigations, Sarah Williams in the Division of Registration and Inspections, Greg Skates, Karen Burgess, John Powers, and Lillian Sanoa from the Office of Chief Auditor, and Andreas Vanelli and Saad Siddiqui in the Office of Research and Analysis. I would also like to thank the SEC staff for their assistance and thoughtful comments on what were often technically complex issues in this project, particularly Brian Croteau, Jeff Minton, and Neil Weingarten. With that, let me turn over to Vince to describe today's proposal.
Mr. Chairman, members of the board, we recommend that you adopt a number of amendments to conform the board's rules, forms, and ethics code to the Dodd-Frank Act and make certain updates and clarifications.
Vince, will you move the microphone closer?
Oh, pardon, of course.
Move it closer. Yeah.
That'll be better. These amendments were proposed in February of 2012. We received 13 comment letters on the proposal, and the project was motivated by the need to update the board's rules to conform to the Dodd-Frank amendments to the Sarbanes-Oxley Act. The amendments would update the board's rules, which are typically framed in terms of issuer audits, to reflect the Dodd-Frank amendments. Many of these amendments are simply a matter of including specific references to broker-dealer audits in rules that currently apply only to issuer audits. For example, the board's registration rule would be amended to reflect that public accounting firms that prepare or issue audit reports for broker-dealers or play a substantial role in preparing or furnishing such reports must register with the board. The release would also amend Section 3 of the board's rules, which require that registered firms and their associated persons comply with all applicable auditing and related professional standards. Now that the SEC has directed that PCAOB standards apply to broker-dealer audits, these basic rules would become applicable to broker-dealer audits. Section 3 also contains the board's independence rules. The board is applying, we recommend that the board apply some, but not all of its independence rules to broker-dealer audits. These rules would prohibit auditors from receiving a contingent fee from an audit client. They would prohibit an auditor from providing services to an audit client related to the marketing, planning, or opining in favor of the tax treatment of an abusive tax shelter, and would require auditors to provide certain annual communications on independence to broker-dealer audit committees. In contrast, independence rules that we recommend the board not apply to broker-dealer audits include the communication and documentation requirements that auditors seeking audit committee pre-approval to perform permissible tax services or services related to internal control over financial reporting not apply to broker-dealer audits. And we similarly recommend that the board not at this time extend the requirements of Rule 3523 concerning tax services for persons and financial reporting oversight rules to audits of non-issuer broker-dealers. We recommend that the board also amend its forms so that they are generally workable by calling for relevant broker-dealer audit client information. Another assessment of the board forms may be required in the future. To take one example, the Form 2, the annual reporting form, would be amended to require that auditors identify each audit report issued during the reporting period for a broker-dealer client. If the firm did not issue any such audit reports, it would be required to disclose the broker-dealer audit reports the firm played a substantial role in preparing during the reporting period. Finally, while we tried to keep it narrow, we also recommend that you amend the board's rules and forms in light of administrative experience and to make a number of updates to address recent events. These amendments would, among other things, amend Form 1WD, the request to withdraw form, to eliminate a requirement that a hard copy of that form be submitted as well as an electronic copy of the form. Turning to effectiveness, the amendments to the rules would take effect June 1st, 2014. The amendments to Forms 1WD 3 and 4 would take effect July 1st, 2014. And the amendments to Form 2 would take effect on April 1st, 2015, covering the reporting period between April 1st, 2014 through March 31st, 2015. And we'd be pleased to address any questions.
Thank you. First, this is our end of the technical work that must be done under Dodd-Frank as a result of the 17A5 amendments, and it's important, very important. I believe these reflected changes reflect a continued, thoughtful, measured approach to our oversight of broker-dealer audits that begin with our interim inspection program, and which we want to continue. The parts of this that I think are particularly of importance to some securities lawyers and others are that we can reflect in our rules our authority under Dodd-Frank to share certain otherwise confidential documents with self-regulatory organizations, and we clarify our enforcement jurisdiction over persons that are formally associated with registered public accounting firms, and that's a significant step. I want to thank Nancy Doty, Vince Meehan, Michael Stevenson, the SEC staff. This is a detailed, difficult task that you have completed, and the length of this release reveals how many of the details have to be thought of, collected, and dealt with, and it's a significant achievement that accompanies any major rulemaking. And with that, I want to turn it over to my fellow board members for any of the statements they wish to make. Harris?
Well, Mr. Chairman, I support the conforming rule amendments before us today, and as Mr. Meehan referenced, while the board initially proposed that auditors or brokers and dealers be prohibited from providing tax services to individuals in a financial reporting oversight role in brokers and dealers, the board has opted not to adopt that prohibition at this time, with an understanding that we are committed to review this decision as we gather and analyze information about the independence issues involved. The board feels it needs more data to analyze the impact on both the audit and broker-dealer community that would be affected. However, if under the board's interim inspection program, the provision of such tax services is viewed as impairing the independence of the auditors of brokers and dealers, I would support the imposition of a prohibition. I also, Mr. Chairman, want to thank Nancy Doty and Vincent Meehan and the work of the SEC and their assistance in these conforming rule amendments. Thank you.
Ferguson?
I just want to say I support the proposed amendments, and I realize that this is a great deal of hard, in some ways tedious, highly technical work that you all have done, and I applaud you for it. Thank all of you and our colleagues at the SEC for it.
Mr. Hanson.
I've got a statement I'm not going to read, but just say overall I support it. Just a couple things to comment on. Board Member Harris just mentioned this rule for the tax services for persons in a financial reporting oversight role. I think it's the right decision that we are making to not impose it that independence requirement today, but to look and see if there is a cause and effect relationship between the findings that we have relative to our inspections of the audits of broker-dealers and whether those tax services had anything to do with it that would cause us to rethink that. One thing to mention that dictated by Dodd-Frank, but the process by which an auditor reports that they've disassociated themselves with an audit client. Right now, when an issuer changes auditors, they have to file a Form 8K, and there's currently a private notification from the firm to the SEC staff when that relationship has ceased, so that they can monitor whether the Form 8Ks are being filed, and that's in 100% of the cases, and I think it's appropriate for that rule to be scaled back in one respect and upped in another respect, and that is scaled back in that the notification would only happen if the issuer hasn't filed their Form 10K or Form 8K reporting the change on time, so that substantially reduces the number of those notifications to the chief accountant's office. But one important additional thing is in the event that in spite of the firms telling the SEC, and the SEC may be following up that gee, there's been no 8K filed to report this change, that the world would never know that the auditor had resigned if the issuer never filed an 8K. And so putting into our rules a requirement that, well, after another 30 days, if there's still not been an 8K filed, that we would put it through the firm would be required to file with us notification, so it becomes public that the firm is no longer the auditor, when it had never been in spite of all the efforts and the requirements the securities law required. I think that's an appropriate thing, that there be a mechanism, which there isn't today in any fashion, to have that double check, or that backstop that the world will know the auditor resigned if the issuer never did their job on it. One further comment on the effective date. It's a little bit unfortunate that we've got several stops along the way for the effective dates, but that's somewhat the consequence of the rules that we're dealing with, and would have been nice to have them all be identically the same time, but just practically where we're at in the cycle, especially with respect to the firm's annual reports on Form 2. It would have been exceedingly difficult for these changes to be effective for the form that's due in June of 2014, when with the SEC process to approve what we're approving today taking a few months. So I think it's appropriate that Form 2 amendment requirement is stated April 1, 2015, with the practical implication of the annual reports due on June 30th, 2015. So there's a good window of time for the firms to gather the additional information related to the broker-dealer clients to include in that Form 2 and the other conforming amendments. With that, I'll turn it over to Jeanette. And thanks to the staff, too, to echo that. Jeanette? Yeah.
I support the adoption of these amendments, and I know it was a daunting task. I also support the continuing study of some of the other issues that we identified, or some of the issues we identified along the way, including the independence rule, as well as Rule 5102 related to the presence of experts during investigative testimony. I think those are appropriate decisions to set those aside and do more analysis there. I think as this process demonstrates, waiting for a big triggering event like Dodd-Frank and then having to go through and review not only that, but a lot of other issues at the same time is a huge task. And so I'm hoping that as we move forward here, maybe we can take off smaller chunks at a time on a systematic basis to do some reviews along the way, so that if we do have another triggering event, it doesn't pull everything back in. But I want to compliment you all on the job you did. I know it was just an awful lot of work.
Questions? Steve, you have a question?
Well, Jay actually answered the question that I was going to ask, and that is with respect to the rules on June 2014, the Form 2 on and the other alternative dates that are interchanged throughout the conforming amendments proposal. I guess the question is, are you working closely with our website people, and what does this mean in terms of information being made available to users on our website?
Yeah, we think we have been working closely with IT and with the folks, Sarah Williams and her team. I think Board Member Hanson summarized our thinking very well, that it would have been nice to have the Form 2 amendments effective for this year, between thinking about the length, the months-long period that the SEC approval process takes, plus the timing for IT implementation, it was difficult to think about how we would end up making that Form 2 effective for this coming reporting cycle. I think because the 2015 reporting cycle will include information from April 1st of 2014 through March 31st of 2015, that as a practical matter, we will have information available for the public pretty soon.
Any further questions by anyone? Okay.
I'm just going to ask one, and that's one of the commenters to the proposal a year and a half ago plus said or made a suggestion that we not go forward with these until we determine the scope of our permanent inspection program for the broker-dealer auditors, and we've chosen to not do that, and realize there's a lot of steps to go before we would ever conclude on what that scope of a permanent inspection program is. But do you think it's possible, or maybe you can embellish on why we chose to effectively go ahead anyway, in spite of the fact that there'll be a lot of consequences for the permanent inspection program, and whether some of what we're doing today will end up needing to be changed when we do the permanent inspection program.
Yeah, Jane, let me try to answer that. I think our judgment was, and as Vince described, many of these rules really just reflect the changes to the board's authority made by Dodd-Frank, as well as implementing the SEC's decision in Rule 17A5 that broker-dealer audits should be conducted pursuant to PCAOB standards that really facilitate that decision that already has been made. For that reason, we thought, again, the majority of these rules, putting aside the forms, should be effective on June 1st of this year, or 2014, to coincide with the effective date of the SEC's rule and our broker-dealer audit and attest standards. We think that's appropriate, again, to reflect that decisions made, that should happen. In fact, I think the board's thinking has been that will, in fact, benefit its interim inspection program to allow some audits to be seen during that program that have been carried out in accordance with PCAOB standards.
Other questions? Jeanette? Yeah.
I realize you're just bringing this in across the finish line and would like to breathe a sigh of relief, but are you thinking about approaches and schedules going forward to do regular and systematic reviews of our rules?
I guess the first thing I would note is, as you said, I thought this was a useful exercise. Many of the rules here that are touched by this rulemaking had been put in place in 2003 and not been amended since that time. So it is important that people appreciate, as part of adding the Dodd-Frank changes necessary to these rules, we took a fresh look and in some respects, based on the staff's experience, found ways to improve or at least clarify those rules. And that certainly was, as I said, a cross-divisional exercise, a useful exercise, and I think it is healthy and normal to do that every time. The other thing to appreciate, though, is that these are just our internal rules as opposed to our standards. They're largely procedural. I think with respect to those standards, I think that's, as I understand, the board's strategic plan initiative for 2014 to think about post-implementation review of those standards, particularly through the board's new Center for Economic Analysis in conjunction with inspections, to think about how to do that. So I think these issues will remain on the staff's forefront. How do we look back at our rules once they're in operation and make sure we're continually making sure they're both necessary and functioning as intended?
Unless there are further questions from the board, would all in favor of approving this recommendation please say yes? Yes. And opposed? None. Thank you again. They are approved. This concludes the public meeting agenda. We have a closed meeting coming up, and perhaps we could give ourselves 15 minutes and be back here at 20 minutes of 12. Does that